I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today we are talking about 5 ways. We're giving you 5 ways to increase how much you can borrow. And while prices are high, this is, a good podcast that we think a lot of you are asking, these questions, and we're trying to give you 5 tips.
So this business, like most things, everyone talks about these acronyms. I don't know if they think they sound cool or not. We don't use acronyms to sound cool. We just think that our borrowers have heard it enough. So what we're talking about today is DTI, the debt to income ratio. Lenders only allow you to have so much debt. Otherwise, anything above a certain amount, you're limited. You don't qualify. So we're trying to help people on how to get some of that, to pay off the debt, yes, as you'll see, but how do we get that lower? How do we get the DTI lower so that you can take on more mortgage debt? And I was thinking of if we were financial planners, this is really kind of opposite of financial planning, because what we're doing is we're telling you how to take on, more house loan. And the purpose here is not to get you into debt, but a lot of people, especially first-time home buyers, don't have the income to have super low debt-to-income ratios. So we're not here saying, take on more debt, America. We're actually quite opposite. What we're saying is if you're having trouble qualifying for a loan, this is how you can qualify. This is how we can get your debt down a little bit. So let's use that as kind of our floor for discussion, and let's get going.
Okay, so let's talk about what a debt-to-income ratio is. We call it a DTI. And the debt-to-income ratio is the calculation of the percentage of your monthly debt payments compared with your gross monthly income. Okay, so we take the monthly debt, and we divide it. So monthly debt divided by your monthly income. That is the debt-to-income ratio. And
for very simple purposes, and I know lenders have a bunch of different, ratios that they use, but for our podcast, we're just going to use 50%. Okay? 50% is on the very, very high side, but it's an easy number for everyone to remember. Lenders typically allow you to run with about half of your income for your debts. That doesn't include utility bills, water bills, cell phone bills, but it's all your loans that you do. So any loan that you have, credit cards, student loans, car payments, private loans, the banks only want you to have half of that of your income per month. So, okay, sorry, go ahead.
All right, so let's just go with the 5 ways to lower your debt-to-income ratio. The first thing we're going to suggest is paying off the debts ahead of time. If you're going to call us today, looking for a mortgage, if you had planned, at least 40 days ahead of schedule, the reason why I'm saying more than 30 days is because you want to get the credit bureaus to report your new balances. You pay off those higher credit cards, or if you have access to the funds to pay off debt, you would do that. And then you would do that about 40 days ahead of time. So paying off debts ahead of time, that's the first, good rule of thumb.
Okay. The next one, and this is one of my favorites. I think this is really the meat of the podcast, by the way, but it has to do with what I call efficiency of debt. Some debt has an overbearing amount of weight on you when really it doesn't need to be. And here's a fun little analogy. Okay. If someone is, let's just say the river. The river is the money for loans. The river's where people go to buy loans. Money's water. The lender's only going to let you carry, as an example, 50 pounds of water. Okay, maybe you could show off and do 80 pounds and, try and work your way back up the mountain, but you're going to end up killing yourself and, falling down the hill. So they're going to say, okay, guys, 50 pounds. Okay, some debt, like cars, are abnormally heavy. Because they're only, you're taking out X amount of dollars, but you're paying it back in a very short amount of time, okay? With mortgages, you're taking out, a big loan, but you're paying it over 30, so those payments are lower. So the debt, the water, so to speak, is lighter. So what we want to be able to do is teach you to say, focus your efforts on getting rid of the heavier debt, the less efficient debt. And one of the big examples are car loans. For every $1,000 of a car loan, your monthly payment is about $17 to $18 a month. Okay. For every 1,000
Okay.
on a house loan, it's about $4 to $5. So it's like, holy cow, that water is so much lighter. Maybe it's rocks we can talk about. It's just so much lighter. So we want to get you in an efficient position, pay off some of those heavier debts. Ed, okay, so I mentioned car loans. What were some of the other heavier debts that we were talking about? Credit cards.
Well, this is all under option. This is our second recommendations. It's to basically pay off or refinance those larger loans over, those larger loans. Or I should say the loans with large payments. And sometimes student loans will have large payments as well. I think it's car loans and student loans are in that category, but I think by far it's the car loans. They're only 60-month loans, sometimes 48-month loans, and they're $800 payments.
Right, and if you're a geek, a math geek, which in our world is a good thing, doesn't mean to be insulting, but if you're a geek, if you want to find out how efficient your debt is, you would simply take your monthly payment and divide it by the actual balance remaining. So if you had a car loan of $200, a month, you would divide that by 10,000, and you would come up with a percent. You do that to all your loans, and what you do is you'd realize that you'd want to be paying off those higher percent. This isn't interest rates, but the higher percent, that ratio of debt, because that's going to allow you to carry more mortgage water, so to speak, more mortgage loan.
So number 3, transfer your credit card debt to a lower interest card, pay it off, get rid of that credit card.
Now,
if you have a line of credit on your home, if you have another, some way to pay it off, get rid of those credit cards.
Yeah. Now, I don't know how this really applies to our podcast today, but we get a lot of borrowers that call in and they're very proud of their 0% interest rates. Okay. I guess for our podcast today, a 0% interest rate is good because it would have a lower monthly payment. But just as a little bit of a side note, that 0% interest rate goes away pretty quick. So don't get too excited about it. For this podcast, that's kind of what you're talking about, I believe, is, some of these credit cards have these huge high interest rates, which are driving your monthly payment. And if you could get, a 0%, interest rate card, transfer that balance, that could help.
Yeah, I think it's going to be borrowers who are having, this would be only really apply to borrowers with high, they have a lot of credit card debt. It's 15% interest rates, things like that. And we don't want you moving around money, between a 5% interest rate card to a 2%. That's a waste of time. It's really high, interest rates with high payments. Getting those into lower cards is an idea. Or if you have a line of credit, something like that. But this is tip number 3 is really similar. You could be done ahead of time, right? Just like tip number 1, paying off the debts ahead of time. But this is one idea.
Okay.
So tip number 4, I think that you just had a situation where you gave somebody a raise.
You know what? Yeah. Some things make you proud to get up in the morning. This is one of my more proud, maybe even one of my most proud moments. But, some people say the expenses aren't the issue. Don't worry about saving pennies. Worry about making dollars. And I had a borrower who needed a loan, and the situation was quite complicated. And we got down to the end, and their debt-to-income ratio was too tight because something popped up last minute. And I said, is there any way that you can, make more money? It's like, well, you can't go out and get a new job. So we actually helped them get a raise. Now, we didn't call human resources, and we're not saying this on a widespread basis, start asking your employers for raises, but it's possible. He was a truck driver. He had been there a little over a year, I believe, and he worked an incredible amount of hours. And I asked his spouse, I said, does the company like him? Does he work a lot of hours? Does he like going to work there? And she said yes to all of them. I said, well, have them go in and get the raise now. If they're going to give him a raise at the end of the year, get it now. And sure enough, he got a $4 raise. You went from $20
That's awesome.
to 24. So what is that on a percent? That's what, 16% raise, something like that. Four divided by 20? No, 20%. Yeah,
20%. Right.
But anyway, so that sounds silly, but I'm telling you, folks, it has happened, and we've had a number of other files where we've gotten a dollar raise. A bonus was actually, usually bonuses are paid in the first quarter. I personally haven't done it, but I know of people that have gotten, bonuses at the end of the year versus waiting. Harder to do that with bigger corporations, but with some of these smaller employers, just be willing to think out of the box. Don't be obnoxious about it, but be willing to think out of the box and get your income up. Don't worry about saving pennies. Worry about making those dollars.
Okay. Number 5. This is something that you're going to be doing it differently, whether you are looking at a home purchase or a home refinance, but it's consider a 401k loan. And we don't want to just recommend you go getting a 401k loan, kind of how you preface this whole podcast. Our idea is not to put you guys in debt, right? You're listening to this to get the debt to income ratio down, not just go and get more debt. Mm-hmm. Your 401k is a very, very good tool for shorter term. We don't have to. You can take a loan against the 401k, and guess what? We don't count the loan and the repayment of that loan in your debt to income ratio. So you can take out up to $50,000 or 50% of the vested balance. That's usually one of the rules, and you can pay off, some of the debts.
So can I
take advantage of that 401k?
Can I give you a classic example? A borrower has a $350 monthly payment on a car. Okay, they've got $40,000 in the 401k. They can, and hear me out here, they can take usually up to half of the 401k out, pay off the car, give themselves a loan. A lot of people say, oh, no, don't ever take a 401k out, or 401k loan out. The only time you ever do is when you buy a house. That's it, period. Okay? Pay off the car, buy the home. After the dust settles, guess what? Has your car lost that much value? Likely not. If it's new enough, go right back to the bank that you had the loan with and simply refinance it. You can actually refinance your car, take out the same amount of money that you used to pay it off. It's probably going to be, your balance will be down $1,000 or whatever, and then pay off your 401k loan. And then boom, you're in your house, you've paid your 401k loan back, and you have your car loan. But the most important thing is you have your house. So, and that's nothing tricky.
Yeah.
That's just thinking out of the box a little bit on how to efficiently and effectively go about managing your money. So yes, using the 401k loan for a house can be very smart. Not always, but can be. I would never recommend taking a 401k loan out to buy a car, to invest in the stock market or do any of that, but to simply help you get that house. So very important. Good point.
Mm-hmm. Okay, so those are the 5 tips that we have for you to lower your debt to income ratio so you can borrow more. If you like what the Mortgage Brothers are doing here, be sure to like our podcast. Put in a comment, send us an email. We'll be happy to help.
All right. Thanks a lot, folks.
Take care, everyone. Bye-bye. Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com and be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 at 1618695, Equal Housing Lender.